So if you're watching this video, it's probably because you are applying for a license for some activity or some business, and you're either being requested to get a surety bond or you're renewing your license and have to get a new surety bond. So many industries are required to be licensed by the state. For example, attorneys, accountants, general contractors, private investigators, insurance agents. And in order to obtain a license for that business activity, the licensing board for the state requires that the applicant obtain a surety bond for their license. And it may seem as simple as just, well, I'm going to buy a surety bond and it cost me a few $100 and I'll attach it to my application. But it's important to know what is going on behind the scenes with that surety bond. First, let's look at why you need the bond and what your liability is. Even with that surety bond, what is your liability for paying that bond? Your liability for that surety bond is actually more than just the payment of that bond. It's not like an insurance policy. If you buy, let's say, business insurance and you pay $500 a year for your premium, you don't have any more liability to pay towards that insurance. Insurance covers your liability. A surety bond, on the other hand, is a one-time payment, a couple $100. However, you have liability to that bond. So first, let's ask, why does the government agency, the licensing board, ask you or demand you to get a surety bond? Well, the bond is there to pay all or a portion of any claims against your license, whether the licensing board charges you a fine, a penalty, a civil penalty, even a criminal fine. The surety bond is there to pay that fine if you don't. In addition, the primary purpose is if a client of that business has a problem with the product or service and the company doesn't have the money to pay, the surety bond will pay. Let me give you an example. Let's suppose that you are a general contractor, builder, that does residential remodels. And your client is an owner of a house that wants to remodel their house. Well, when you became a licensed general contractor, you purchased a surety bond in order to get your license. And let's say you start the work for this client and you don't finish, and you charge them money for this work, and you damage their house and you put the house in worse condition than it was when they started, and now you took their money and now they're stuck, and you go out of business or you disappear. And they file a complaint against you, and they also file a complaint with the licensing board for your state. And the licensing board is the agency of the state, government agency, which issues that license for being a general contractor. And so if the property owner files a complaint and they win because you breached the contract, they might get some kind of a judgment or claim against you. More than likely, they're going to win a judgment of damages. You're also going to have different types of fines associated with it. The licensing board might issue a penalty. They might not only cancel your license, but they might charge you a fine, $2,000, $5,000, $10,000. And if that order from the court or from the licensing board orders you to pay, if you don't pay voluntarily out of your pocket for whatever the fines are, restitution, recovery, refunds, whatever it is, the bonding company will step in and pay. The licensing board will know the name and address of your bonding company because you have to file that bond with your license. They will contact that bonding company and say, hey, XYZ Bonding, remember when you issued that bond a few years ago to Joe Schmo, private contractor? Joe Schmo Contracting Agency, whatever it's called. Yep. Well, guess what? We have an order against them of refund, and they didn't pay. So you got to pay. So the bonding company is going to verify that this is all true, and they're going to write a check for whatever the damages are. $18,250.12, whatever it is. And when that happens, now the licensing board has their money. The client is made whole. You're back to normal. But now you have a liability. Because unlike an insurance policy, when you have commercial insurance, the insurance company pays out a claim. They paid it. They lost it. It's their money. You don't owe them anything. On a surety bond, if there's a payment, the surety bond company is indemnified by you to pay them back. Now you got to pay them. And you might think, well, then if I'm paying it anyways, why bother having a surety bond? Well, the surety bond is there to make sure that somebody with deep pockets is able to pay for consumer claims and losses. That's what it's there for. So what do you have to do to get a surety bond? And we'll talk later about that recovery process. First of all, in most industries, the surety bond has to be on a certain form with certain language and wording, very specific wording. It has to be written by a surety bond agency or a surety bond producer that's licensed in the state where this activity is happening. So if you're getting let's say a license to be an attorney in the state of New York, your surety bond company has to be licensed in New York. Can't be an out-of-state domicile. You have to put the bond in with the application. You can't say, I'll get it later. You have to go in with the application. It has to be an original. It can't be a photocopy because they have to see that it's not been tampered with, altered, changed, maybe backdated. It has to be original. Has to be on their form. And we'll take a look at an example form here momentarily. And the name of the person that's listed on the bond has to be exactly the name of the licensed entity. Has to be the same legal name. If you are Joe Schmo Building Contractors, LLC, it can't say Joe Schmo Builders, LLC. It's got to be word for word, letter for letter, exactly what's on there because it's a legal identity. It has to match what they're going to pay out. If there are partnerships, sometimes you have to list all the partners. The bond has to have an original ink signature on it. Can't be a stamp or digital or any other photocopy. It's got to be original. The bond really doesn't become valid until it's put in effect by the licensing board. So until you get your license, the bond is just provisional in most cases. And the language of the bond has to say it's in effect until it's canceled. Doesn't expire at a certain time. So let's take a look at an example of a bond. This happens to be for a building contractor in the state of Oregon. The state of Oregon is administered by an organization called CCB, which is referenced here, Construction Contractors Board. And the surety company will put their bond number here. And you, as the purchaser of the bond, as the contractor, are called the principal. And your name will go here. This person is a residential contractor. This person, this principal, is applying for a license and a residential endorsement from the Construction Contractors Board and is required to furnish a bond in the amount of, boom, and you put the amount there. And there's different amounts for different types of contractors in this state, 10,000, 20,000, 50,000. And the bond has to be issued by a business in the state of Oregon called a surety. That's the name of the company issuing the bond. They're called the surety. And that company will put its name here. And that company is saying that they hereby bind themselves. That sounds like a pretty restrictive word. They're binding themselves to pay to the state of Oregon blank amount. And that's the amount that should be matched here. The obligation is void if in accordance the principal pays the amounts. So if the contractor in this case pays any fines or restitution or refunds, then the surety doesn't have to pay. They only have to pay if it's a deficiency. The bond is for this exclusive purpose. It's not for anything else, for determination of orders. The bond is one continuing obligation, and the liability is for the aggregate of all claims, not just for one claim, it's for all the claims. It's effective on the date, cancellation, and other details. And then it has to be dated. The name of the surety has to sign. And it says, no, this bond is not valid until licensing is completed. The reason that's important is because the surety company doesn't want to be on the hook for losses to a business that's not even licensed yet. So if you buy a bond and you apply for a license and you don't get a license for 3 more weeks, if in that 3 weeks you start doing business before you have your license, which would be illegal, and you create a loss, the surety company is not going to pay for that. It tells you some checklists. Make sure the license number's on there, the bond number's on there, the first name is exactly as registered. You notice the word exactly is in bold and capitalized and underlined. They want to make sure that there's no variation, because if there's one letter difference, the surety could deny a claim because they said, no, this isn't for this person, it's for somebody else. Make sure the surety's name is on the second line, the amount of the bond, it's signed, and if there's a power of attorney, you have that. Applicant, this is the principal. The bond must be issued in the exact entity name. They can't say that enough, right? If you're a new licensed applicant and you don't have a bond company, send it to the CCB. The completed original bond must be submitted with the application. Renewals, they can send it to the CCB. You have to have that get to the board within 60 days of the date on the bond. So you can't buy it too early. If you buy this 3 months before your license, it's going to expire before the license is done. So how does this work for other industries? Well, the wording might be a little different. The amounts might be different. But in reality, it's the same process. It's a way for a licensing board to ensure that the company, business, person, whoever it is, that they're granting this privilege of having a license to do business in a certain industry has protection for the customers and has protection for the state if they have to issue fines. So if you're a car dealership, you have to get a bond, because if you take a bunch of people's money and deposits and payments for cars and then disappear in the middle of the night, those people are going to be out of luck. Because the car dealership has a license issued by the state, those people might go to the state and say, hey, you license this company, you should fix my problem. So anytime the state is granting a privilege or a license, many times they're going to want backup to make sure that if that person messes up, that the customers will be taken care of. Because part of the reason that customers will do business with a company that's licensed is because they have that certificate, that credential, that license. And the state is kind of putting their blessing on your business by granting you a license. That license is probably going to be hanging up on the wall in the business or on their website or talked about. You've seen companies that brag about that they're licensed, bonded, and insured. And that's a way to give the customer some peace of mind that they're safe. So that license from the state or from the government, in some cases federal, is a credential you can use to kind of help talk people into doing business with you. Because the state granted that license and they're kind of giving you their, seal of approval, they want to make sure that you have some backup behind you so that if you do disappear, somebody else is going to step in with some money. Because if you disappear, it's probably because you have no money. Now, there's some alternatives. In some states, for some licenses, instead of getting a surety bond, you can just put up a deposit. If the bond is required to be $20,000, for example, you can put a $20,000 non-refundable deposit into an account, a trust account, so that if there's a claim that happens, the state can tap that account. You know, most businesses would rather pay a few $100s for a bond rather than tying up $20,000 in working capital. That's why surety bonds exist. But the point is, the agency that issues the license wants to make sure that that licensee is taken care of and that they are properly protected. One thing you noticed on that surety bond, it didn't mention the identity title of the government agency. Whoever is the beneficiary of the bond, that person or company is called the obligee. That's a term you'll see on surety bonds, an obligee. So you have the principal, the surety, and the obligee. So unlike an insurance policy, which has two parties, the insured and the insurance company, a surety bond has three parties. And each one of those has a responsibility to the contract and a reason for them existing on the contract. So to start back where we began, if you are a company that needs a surety bond for purposes of licensing, sure, you can just easily buy a bond. There's lots of places, lots of ways you can buy it. You can buy it online. It's usually very inexpensive, a couple $100, a few $100, depending on the nature of the bond and the amount. But knowing what the bond is for, why it's being asked for, and what your obligation is important. It might help you manage your business better. We've talked to a lot of people that have had the scenario in life where they actually had to claim against the bond. You know, they were a party to a contract, and the other party breached the contract, and they claimed against a surety bond, and they were made whole. But the party that had the bond didn't realize that they had to pay the money back. And so now all of a sudden they thought that they had some protection. They thought the bond was like an insurance policy that protected them. So if they breached the contract or failed or did something wrong, they're like, well, it doesn't matter to us. This bond will take care of everything. Yeah, the bond will step in and immediately pay the money to whoever had the loss. But they're going to come back with an open hand looking to you and saying, okay, you got to pay us back. And that's an important thing to be aware of so that it helps you run your business better. Because even if you pay it back, once you've had claims on a surety bond, it's going to be hard to get another bond later because the bonding agencies will report to one another. So understanding the benefits of a surety bond, how it helps you get to license, and how it can help you with your clients. And if you talk to a client that maybe doesn't know your business, doesn't know your business background, doesn't know the stability of your business, you can let them know, honestly, well, there's a surety bond. We have a bond that protects you. If anything happens and we don't take care of it the right way, this bond will take care of it. Just make sure you're not misrepresenting what the bond means, like it's not a guarantee or a warranty that you're providing. And if you're doing anything with a surety bond, whether you're discussing it with clients, whether you're buying one, you might want to get good legal advice from an attorney. We're not giving you legal advice. We're not a law firm. We're just telling you how bonds work in general so that you can ask questions to the agent or broker or surety company that's issuing your bond so you can understand it better and get the right answers. How much is a bond going to cost? Well, in most states, the price of that bond is going to be the same no matter where you buy it. In most states, the bond is a fixed price filed by the surety companies, and they're all going to be the same from one agency to another. It's more about who gives you better service, who's easier to deal with, who can get it to you quicker. Maybe in some cases who approves it, because it's not automatic you would get approved for a bond. If you don't have experience, or if you have maybe bad credit or some lawsuits against you for similar problems, the bonding agency might not want to maybe back you up because they might be at more risk. Again, for them guaranteeing $20,000 of risk for a couple $100, they're not planning on having to pay out. That's the whole point of a bond. They're not planning on having to pay this money out. They're planning on just being there as a backup. But if they were planning on having to pay it out a lot of times, it would cost a lot more than a few $100s for tens of thousands in coverage. So they're going to make sure that they don't think they're ever going to have to pay. That's the point of the bond. So you having good credentials, qualifications, and maybe a resume will help make that process go smoother.